Hello, it's Vicki Salen. I'm going to talk today about a particular class of assets, that is intangible assets. There are four different types of intangible assets. We're also going to look at a couple of ways that we can measure them. By their nature, intangible assets are hard to value. If we're easy to value things such as reputation, brand loyalty, human capital, ways of organizing and managing, those sorts of intangible skills are difficult to value, but there are some experts in the financial world, particularly Dr. Baruch Lev, who have specialized in ways to measure them. This presentation covers intangible assets, the four important classes of them, and different possible ways that you can value them. Here's the four types of intangible assets: ideas, brands, ways of working, and franchises. All of these involve creativity, they involve innovation, and to the extent that they're valuable and difficult to imitate, they could be a source of consistent competitive advantage for a company. Ideas result from a company having invested in R&D. They involve innovative products. And don't forget how packaging innovation can also contribute to intangible values. And to some extent, they involve line extensions or spin-off products that come from an original product. It would be possible to value an intangible asset in the area of ideas by tracking a company's expenditures on R&D. Supposing you work for the company, it ought to be quite easy to go and look at the expenses historically on research and development. Which financial statement would this expense be on? Would be in the income statement, and it would be something that one could track year over year. If you're an outside researcher, it's a bit more difficult to find this. Sometimes on a published income statement of a investor-owned firm that trades in the public equities markets, you can find an entry for R&D, particularly those companies that are ag-oriented innovators, such as the seed firms, the new product firms. Sometimes you will see their R&D expense listed out separately. Brands are a very common form of intangible asset. It allows a company to differentiate one product from another and therefore to capture markups. In your economic theory, you knew that if a product was differentiable, then there would be a potential for a few firms to attract the consumer's loyalty and therefore mark up the price. There's a great amount of expenditure by consumer product goods companies to promote their brands. I have here some data that's quite old. You could probably look at Advertising Age or some other recent publications that you learned about in your marketing study to find how much is spent on media. Even these days, when television is no longer your prime media, your only media source, there is still a huge investment made in television advertisements for big audience-drawing events such as the Super Bowl. Back in 1998, when I collected this media spending data, there was very little in the form of IT, social media advertisements, which today take up a lot of attention. And maybe per unit of exposure or a consumer's view, those are cheaper advertisements, but the total amount spent is still quite remarkable. Ways of working are more complex intangible assets that involve process within the firm, to some extent structures and organizational rules within the firm, but they are often referred to as a knowledge asset Not the scientific discovery that came from the idea, but human capital and process. The advantage to a firm is that once that way of working or structure and process comes into being in the firm, it can be used in different units quite readily. Now, knowledge assets can be difficult to manage. Sometimes it's dependent on a certain set of leaders. Sometimes, though, they can be copied from one firm to another. Here's an example of a way of working or an intangible asset related to structure of the firm that was very important in the food industry. This was in the early 2000s when Kellogg Company purchased Keebler. Keebler owns several brands of cookies. That's a sweet snack. And that acquisition wasn't done so that Kellogg could expand its product line and add to breakfast cereal, have some other sugary, crunchy product to sell. No, they bought Keebler, according to the investment analysts at Bain & Company, in order to get the direct store delivery distribution system. Direct store delivery involves the trucking, physical delivery, and bypasses a great deal of warehousing, especially the step of warehousing that used to require a third-party food service supplier. So direct store delivery is used by a number of firms throughout the food industry. It gives some franchise benefit to the trucker who's involved in it, and it also is more efficient than the third party. Now that system, which Keebler was known for at the time, was attractive enough to acquire the whole firm. It wasn't just that Kellogg could say, that's how they do it, we'll copy it. It had to take an acquisition to bring it within the firm. The fourth type of intangible asset is a franchise. Now, a franchise is a legal contract that gives monopoly power. Franchise form of business is very important, commonly used in the food services sector. The retailing through quick service restaurants in particular are often franchise. Because the owner of the franchise controls who obtains the right to run that business under that corporate umbrella, it's legally binding, and therefore the competitive market, the number of entrants in that market is controlled by the franchise holder. There's only so many McDonald's franchises permitted in a particular town, and once a franchisee is successful, sometimes they can go back to the corporate and purchase additional franchises and then expand their company based on that assurance that there's monopoly power. The other aspect of a franchise is that many of them also offer a brand, set of recipes, ways of organizing the retail outlet, all kinds of standard operating procedures that help someone to get started in the business and not have to replicate that entire set of operations. So a franchise is a sunk cost from the point of view of the franchisee. Someone has to pay a considerable amount to purchase the franchise from that franchise holder. Therefore, when you're studying franchise form of business and you're trying to decide on a financial analytical approach, your quantitative model is simply like a net present value model. You've got an initial upfront franchise fee. That doesn't always buy you the whole brick and mortar of the store and all of its fixings and fittings, but it does include the right to do the operation. So the incremental results of investing in that franchise fee at the initial phase is a whole stream of future cash flows from that operating facility. So it's a sunk cost, it's an upfront investment, and just by looking at the size of that investment, we can infer that the franchise has considerable value. If you want to estimate exact values or estimate some quantitative values for intangible assets, you can look to accounting rules. And those of you who are going to go on into the accounting and advising on accounting world will probably touch upon these rules for valuing intangible assets. There's a difference between US-based accounting and the international financial standards. And brand value, whether or not it can be reported distinctly and separately as a brand value, it would be different for the US compared with other countries. In either case, whether you're an international firm or one listing in the United States, the point of a balance sheet is to show the value of assets in a reasonable, verifiable, and unbiased way. So if it's possible to see from the accountant's records on a balance sheet of a firm what the brand and other intangibles are worth, that's a nice way for us to get started. US will be moving toward international accounting, so you may need in your practice, if you're going to specialize in finance and accounting, to become experienced or become more expert in how brands are valued under the international financial standards. You can see a goodwill entry on some US companies' financial statements. This can be one way to estimate the value of an intangible. If a company acquires another and pays a purchase price that exceeds the fair market value during that acquisition, obviously there must have been something intangible to drive that difference. And that's the origin of a goodwill entry, which you might see on a balance sheet from time to time. Dr. Baruch Lev has indicated that it might be better to value intangible assets based on the accumulated sum of all the expenses that went towards those brands or intangibles. For example, one can accumulate past R&D, any sort of testing and advertising expenditures, and then say if the company has spent X over time on that set of intangible assets, that's a good approximation of value. It's a bit more direct, defensible to me as an economist than just saying, well, here's what the company wrote down for goodwill. Now, we would like also to be able to tie in a market-based measure when we're looking to value intangible assets. We as economists know that we would agree that something has value if buyers out there in the market assign it that value. So there's two valuation measures that we're going to test that involve market indicators. And by market, I mean the stock market, an equity valuation in the stock market. We're going to take an example of the world's best known brand. I think it's still the best known brand in the world, Coca-Cola. Coca-Cola Company organizes itself with separate publicly traded firms, one that controls only the recipe and the brand. That's Coca-Cola Company, KO. It's headquartered in Atlanta. Now, a company that has a fabulous recipe for a product doesn't have much value if that product isn't produced, bottled, distributed to the consumers. And for that reason, that second function, which doesn't have too much idea in it, distribution, it doesn't have a brand in it, distribution, those operational types of activities which take place all over the world, Coca-Cola has organized them into separate publicly traded firms where the bottling is done. Each of these bottlers is in a way a franchisee of Coca-Cola Company. Some of those bottlers can sell other goods besides the Coca-Cola recipe, but they do have the right to use the Coca-Cola recipe and to distribute products with that brand. In Australia, there's a bottler. There is also used to be one large bottler in Latin America. Coca-Cola Enterprises, CCE is its ticker symbol. That's the #1 bottler in the USA. And Coca-Cola Company does invest some of its capital in Coca-Cola Company. In the United States, there's a second bottler as well, goes under the ticker of Coke. Okay, so these are separate publicly traded companies, and one could easily go obtain their financial statements and analyze different features of how they perform. One would think that the owner of the brand would be able to mark up the price on that brand to its bottlers and franchisees and have higher margins than the bottlers whose asset is really the set of customers that they have. I have a bit of information about the cost structure for a Coca-Cola bottler. Costs are roughly distributed into 20% of the expenses are payments to Coca-Cola Company for the concentrate. That's a special recipe ingredient. Then it's mixed with the soda water and carbonated in the bottler's facility. Each bottler spends roughly 50% of its expenses on advertising. In order to keep that brand competitive, there's a great deal of expenditure on advertising. And then the remaining 30% of expenses are used for franchise profit and spent on some fixed cost packaging and transportation. So we can see that there's considerable investment from these bottlers into the intangible of the Coca-Cola brand and its fairly unique way of working with structure of subsidiary publicly traded firms. Okay, so there's two particular measures of the value of intangible assets that we can estimate using stock market valuation and some income statement information. The first one is the change in operating margin. We can obtain operating margin, that is EBIT divided by revenue. That would be your percentage operating margin. And look how that grows over time. A rise in that would indicate more and more profitability, and it would indicate higher and higher value of intangible assets. A market-to-book ratio is also a way to estimate the value of the intangible. By book value, we would be looking at the balance sheet and calculating the net asset value, that is assets minus liabilities. That remains equity. The remainder of that is the book value of equity. Then we go to the stock market and estimate market capitalization. That's what's meant by the market portion of the market to book ratio. Market capitalization is obtained by the value of the stock, which is traded in the public markets, times the number of shares outstanding. And for a large company such as Coca-Cola, that stock price might be really high because the market perceives that the future looks good. It might be a bit compressed if the market's perceiving that the future looks bad, but quite often the total capitalization of a company is considerably higher than the book value of the assets. For a company such as Coca-Cola, KO, its assets don't include very many buildings, equipment, processing facilities. Its assets are probably all intangible, and they might not be too high. So the market value would be the estimate of all the investors' ideas about the true value of the company, including its intangible assets. So the market to book ratio is pretty readily available or readily easy. So the market to book ratio is relatively easy to estimate. We have to go to the stock market and find the current price of the shares and the number that are outstanding. Okay, so in order to calculate, remember, operating margin comes from the income statement, and you could choose what period of time you want to look at to see if the operating margin continued to improve for a company, and part of that may have had to do with the ability to mark up that price because the brand was conveying more and more value. The market to book ratio, we need to go externally. Now this metric can be criticized in a way because we know that the book value of equity is affected considerably by how the firm chooses to capitalize debt to asset, and for the way in which they book value of assets and then depreciate them. This involves a great deal of accounting. And so economic experts often prefer that the best representation, the best proxy of market value is, or the value of a firm is to go to the market. We would calculate market value of equity, which is synonymous for market capitalization, by taking the price of a share times the number of shares outstanding, and that gives a figure, probably for Coca-Cola, in billions of dollars of the value of that firm. Okay, so there's two measures for intangible assets that use financial statements. The latter measure uses, in addition to financial statements, external data from the equities markets, which is easy to obtain. Therefore, we can get a quantitative representation of intangible value. So Coca-Cola is a good example. You could stop here and do some calculation and answer the question, how large are Coca-Cola's intangible assets? And do you have a precise dollar estimate of the value? Now that we have it for Coca-Cola, which when I started, I claimed it was the #1 brand in the world, think about this for other companies, especially those in the food and agriculture sector. Our next case is going to be Nestle, a global company with some well-known brands, but the case study itself talks about new and different things involving health and wellness that Nestle's trying, things that aren't as well known by the general consumer. Do you expect any differences in the value of intangibles for those two companies? Looking back, compare it to Tyson, a company known for processing meat and also known for doing it well, but maybe not able to capture as much brand loyalty as a company like Coca-Cola or Nestle. Okay. So that concludes my talk with you about the value of intangible assets. Thanks for your attention. Bye-bye.